Why the stock market is so high while the economy is collapsing. It doesn't make sense, right? You walk through your city, stores are closing, rent is rising, layoffs are everywhere, and people are struggling to buy groceries. Yet when you check the news, the headlines scream, stock market hits record high. How can the stock market be breaking records when the real economy feels like it's falling apart? Are investors blind, or is the system itself rigged? 1. The stock market is not the economy. This is the biggest misunderstanding most people have. The stock market measures how publicly traded companies are performing. The economy, on the other hand, measures how everyone is doing, from factory workers to small businesses to families. In other words, the stock market is a reflection of corporate profits, not human well-being. When Apple or Microsoft's share prices rise, it makes investors richer. But it doesn't necessarily mean jobs are increasing or wages are improving. In fact, a company can lay off thousands of workers and still see its stock price jump. 2. The Federal Reserve, the invisible hand behind the market boom. Here's where things get even more interesting and a little darker. When the economy starts collapsing, the Federal Reserve, America's central bank, steps in to save it by cutting interest rates or printing more money through quantitative easing, QE. In theory, this helps businesses borrow cheaply, encourages spending, and keeps the system alive. But in reality, much of that newly printed money doesn't flow to everyday people. It flows straight into stocks, bonds, and assets. When interest rates are near zero, investors have two choices: keep cash in the bank and earn almost nothing, or put it in the stock market, where returns are higher. 3. Corporate manipulation, the buyback addiction. Another big reason the stock market stays high is something called stock buybacks. When a company makes profits, it has several options: reinvest in new products, pay employees more, expand operations, or buy back its own stock. And that last option is the market's favorite. When companies buy back their own shares, the number of available shares decreases, which artificially inflates the stock price and makes investors happy. Even worse, many CEOs have bonuses tied to stock performance, so they have a personal incentive to pump up share prices rather than improve long-term growth. During crises like 2020 or 2023, instead of helping workers, many corporations took cheap loans from stimulus programs and used them for buybacks and executive bonuses. Result: stocks soared while wages stagnated. It's not magic, it's manipulation. The stock market isn't always rising because companies are doing great. It's rising because they're buying their own success. 4. Inflation and the asset illusion. Now let's talk about inflation, the silent force that distorts everything. When central banks print money, it doesn't just make goods more expensive, it also makes assets like stocks, real estate, and gold appear more valuable. So while your grocery bill doubles, your investment portfolio might also go up. But here's the trick: you're not actually richer. The dollar just buys less. This is called asset inflation. 5. The psychology of hope and FOMO. Markets run on emotion, and in times of crisis, hope becomes the most powerful currency. Even when the economy looks bleak, investors bet on the future, not the present. They buy stocks because they believe things will get better, or because they fear missing out when they do. This FOMO, fear of missing out, drives prices up far beyond what logic would justify. 6. Tech giants, the new economic gods. Another reason the stock market looks deceptively strong is that a handful of giant tech companies dominate it. In the US, the Magnificent Seven, Apple, Amazon, Microsoft, Google, Meta, Tesla, and Nvidia, make up a massive portion of the entire market's value. So when these companies perform well, the entire index, like the S&P 500 or NASDAQ, looks strong. Even if hundreds of smaller companies are struggling or bankrupt, these tech titans continue to grow because they operate globally, automate jobs, require fewer workers to generate profits, have enormous cash reserves. 7. The global factor: capital has nowhere else to go. Here's another overlooked truth: the stock market is rising not just because of local investors, but because global money is flowing in. When other countries face instability, wars, currency collapses, or inflation, wealthy investors move their money into U.S. stocks or major global markets because they seem safer. It's called the flight to safety, and ironically, it pushes the markets even higher. So even when America or Europe faces economic pain, the stock market keeps booming because it becomes the least bad option for global capital. The result? A global bubble powered by fear, not growth. 8. Artificial intelligence and the new productivity mirage. In 2025 and 2026, another force joined the mix: AI hype. Artificial intelligence promised a revolution in productivity and efficiency. Investors poured billions into AI-related companies, sending valuations into the stratosphere. But while the market sees this as progress, the human economy sees job losses and wage stagnation. 9. The dangerous truth. The market is addicted to stimulus. The modern stock market behaves less like a healthy economy and more like an addict, hooked on cheap money, low interest rates, and constant government support. Whenever growth slows, investors expect the central bank to intervene, and they price that expectation into stocks. It's a dangerous cycle. 1. The economy weakens. 2. The Fed cuts rates or prints money. 3. Markets jump in anticipation. 4. Real problems remain unsolved. It's like giving painkillers to a patient who needs surgery. The symptoms disappear, but the disease grows. The market has become addicted to the idea that the government will always rescue it, creating a bubble that's more psychological than financial. 10. What this means for you. So what can you do in a world where the stock market lives in fantasy while the economy bleeds reality? Here's the truth. You can't control the market, but you can control your strategy. Don't chase hype. Just because the market is high doesn't mean it's healthy. Diversify your investments. Don't rely on one stock or one sector. Focus on value, not noise. Look for companies with real cash flow, innovation, and purpose. Hold for the long term. Short-term chaos always hides long-term opportunity. Conclusion: the great disconnect. The stock market isn't rising because the world is thriving. It's rising because money has been redefined, and the system rewards perception more than production. It's a mirror that reflects greed, hope, and illusion all at once. While people tighten their belts, Wall Street inflates its numbers. While wages freeze, stocks soar. But history has shown every bubble, no matter how high it climbs, eventually faces gravity. So if the market looks unstoppable today, remember, the higher it goes without reason, the harder it falls when reality returns. Don't get lost in the illusion. Learn, prepare, and protect your wealth. Not with fear, but with wisdom. The next financial storm isn't a matter of if, it's a matter of when. When it hits, make sure you're not the one holding paper dreams. Build real value, stay informed, and never mistake the market's rise for your security, because the economy can collapse overnight, but knowledge lasts forever. Now, before you take that final step, let's go a little deeper into what separates average investors from those who actually build life-changing wealth. The advanced psychology of investing. Most beginners focus on what to buy, but the pros focus on how to think. The truth is, markets don't just test your knowledge, they test your emotions. Every dip, crash, and sudden rally is a mirror showing you your patience, greed, and fear. To win this mental game, you need to build emotional discipline. The key is learning to stay calm when everyone else is panicking. The stock market punishes emotion and rewards consistency. Whenever fear hits, remind yourself, price is temporary, value is permanent. Also, understand that boredom is a sign of success. When investing feels dull, it usually means your system is working. Recognizing investor traps. Even smart people fall into classic traps. They chase hot stocks because everyone's talking about them. They sell too early because they crave instant results. They confuse short-term noise with long-term reality. The antidote: think like a business owner, not a gambler. Before buying a stock, ask, would I still want this company if I couldn't sell it for 5 years? If the answer is yes, you're thinking like a real investor. Timing the market versus time in the market. You've heard it before. But here's why it matters more than you think. Timing the market is like trying to catch lightning in a bottle. You might get lucky once, but you'll miss the storm the next time. Data from decades of returns shows that missing just the 10 best days in the market can cut your total gains by half. Staying invested through ups and downs, however, nearly always leads to better outcomes. So don't waste energy predicting. Use that energy to stay consistent. The power of dollar cost averaging, DCA. This is the silent weapon of patient investors. Instead of waiting for the perfect time to invest, set a fixed amount you'll invest each month, no matter what the market is doing. This strategy removes emotion, reduces risk, and builds massive wealth over time because you buy more when prices are low and less when prices are high. Even billionaire investors use DCA to maintain balance and discipline in uncertain times. Protecting yourself from yourself. Your biggest threat isn't the market, it's your impulses. Avoid checking your portfolio daily. Avoid comparing your returns to others. Avoid chasing fast profits. Instead, create an investor code, a set of personal rules that guide your decisions. For example, I will invest for at least 5 years before judging results. I will never sell in panic. I will reinvest my dividends. Simple principles like these can protect you from emotional sabotage. Diversify like the pros. Don't just hold tech stocks or one country's market. Mix your portfolio with global exposure, stable dividend payers, and maybe some real estate or bond ETFs. Professional investors diversify not because they expect every bet to win, but because they know some will fail. Success is about surviving the losses long enough to enjoy the gains. Long-term vision, the true wealth multiplier. The market rewards believers, the ones who treat investing as a lifelong partnership with human progress, not a get-rich-quick game. The smartphone in your hand, the medicine you take, the technology that powers your home, all exist because investors once took a chance on innovation. When you invest in the right companies, you're not just buying shares, you're funding the future. That's what separates a speculator from a visionary investor. And when that mindset clicks, everything changes. You stop seeing crashes as losses and start seeing them as discounts. You stop doubting your journey and start trusting your system. You realize that wealth doesn't come from luck. It comes from time, consistency, and patience. So here's your challenge. Before this week ends, open your first investment account. Start with any amount, even $50. Read one investing article or watch one finance video daily. Let small steps create massive change. Because 1 year from now, you'll either wish you started today or you'll be grateful you did. Your money is waiting for direction. Give it purpose and watch your future transform.